Is it possible that one company has risen up to the point where in the early years of the 20th century, they were able to essentially seize control of the economy of the United States, or at least a large chunk of the finance part of the economy of the United States, use it to make themselves massively rich, in the process devastating the rest of us, creating the Republican Great Depression, and that they're doing it again now, 80, 90 years later? Matt Taibbi is suggesting essentially just that over at rollingstone.com. His article about Goldman Sachs is the company. Matt, welcome to the show.
Thanks for having me on.
The article, The Great American Bubble Machine, From Tech Stocks to High Prices, Goldman Sachs has engineered every major market manipulation since the Great Depression, and they're about to do it again. And Matt, this is a brilliant and masterful bit of reporting. Since you first published it in the National Affairs part of Rolling Stone, on page 52, in fact, in the July 9 through 23 edition, since you first published this thing, apparently the company has pushed back.
Yeah, a little bit. It's funny, I kind of didn't expect that they would, because looking back at their history with hostile journalists, their usual MO is just to kind of no comment everything.
Ignore it and let it go away.
Right, and that's kind of what they did before the story was published. I had sent them a list of sort of simple factual questions to see if they would even engage me for the story, and they completely declined. But since the story's come out, they've basically said that it's a bunch of conspiracy theories, that it's wholly invented, but what they haven't done is really deny any of the factual allegations in the piece. So it's sort of unusual that they would take the time out to answer the criticism, but the fact that they haven't really refuted anything is kind of interesting.
So let's go through some of the factual allegations, and perhaps starting at the present and working backwards. You point out that former Goldman CEO Henry Paulson was the architect of the bailout. Bill Clinton's Treasury Secretary, Robert Rubin, spent 26 years at Goldman. John Thain, the chief of Merrill Lynch, who bought an $87,000 area rug for his office as his company was imploding, a former Goldman banker. Robert Steele, head of Wachovia, a Goldmanite. He and his buddies, $225 million. Joshua Bolton, Mark Patterson, Ed Liddy, all these guys in the Bush and the Obama administrations.
Yeah, and that's just kind of the start of the list. I mean, it really goes on and on from there. The head of the Canadian National Bank, the Italian National Bank, the World Bank, the New York Stock Exchange. These are all ex-Goldman people.
And the New York Fed.
And the New York Fed.
Which regulates Goldman.
Which regulates Goldman. In fact, the chairman of the New York Fed last year was a guy named Stephen Friedman, and he ended up having to step down because of a controversy where he was buying shares in new shares in Goldman even after he had assumed, even after Goldman had been converted to a bank holding company and made itself subject to the purview of the New York Fed. When he stepped down, the new president of the New York Fed ended up being a guy named William Donaldson, I think it is William Donaldson, who's also a former Goldman banker. So, one leaves and another guy comes in, and it's, they're all over the place.
Let's go back 100 years. How did this company that started with relatively humble and straightforward and really admirable, plucky beginnings, shall we say, cause the Great Depression of 1929?
Well, I mean, it's a little bit hyperbolic to say that they caused the Great Depression of 1929, but what they did do is they created a series of investment trusts, the most famous of which were named Shenandoah and Blue Ridge, which were really the outstanding examples of the utter insanity in the years leading up to the Great Depression. They were highly complex vehicles, but the essence of them is that they were enormous leverage-based investments in which Goldman was essentially borrowing huge amounts of money to create new investment vehicles and then betting with that borrowed money to create new investment vehicles on top of those. It was kind of a financial
And in fact,
game.
according to your article, they would create a trust they would sell the shares of that trust to the public. They would buy themselves shares in the trust that they had created in a way that would drive up the apparent demand for the trust, which would drive up the price, so that as the public paid higher and higher prices, since they actually were the ones behind the trust, they were just vacuum hoovering up all this money.
Right, exactly. And what's interesting about that, obviously this kind of ancient history wouldn't be relevant really at all to the current situation had not it been true that a lot of what they did with those investment trusts not been sort of replicated in some of the recent scandals. Some of the same behavior went on in the internet IPO years when underwriters like Goldman had all sorts of schemes to get clients and to get insiders to continually drive up the price of the stock early on, to sucker in outside investors to come in and keep the share price going up.
Right, the dot-com boom. In other words, you're suggesting was it largely Goldman, partly Goldman, or were they just part of a national craze?
Goldman was the leading underwriter of dot-com stocks. They did more dot-com IPOs than any other company. In fact, by the height of the boom, 1 out of every 5 internet-based IPOs was being underwritten by Goldman. And what's important to remember about this is that one of the things that was really damaging about the internet IPO years is that it was sort of the beginning of the end of underwriting standards on Wall Street. Once upon a time, companies wouldn't take, investment banks wouldn't take companies public unless they had existed for 5 years, unless they'd been profitable for 3, unless they were profitable at the time of the IPO, and unless they were projected to make money within the near future. And when banks like Goldman came around during the internet years, suddenly they were taking companies public that had only existed for 5 minutes and had no prospects at all of making money anytime in the near future.
Right.
So it was this enormous collapse of standards that really set the ball rolling for all sorts of disasters during that time period.
Not unlike the collapse of standards in collateralized debt obligations,
absolutely,
in tranched mortgages, et cetera, et cetera.
Absolutely.
So is this tinfoil hat thinking to suggest that Goldman, for example, was behind the oil spiking to $140 a barrel?
No, absolutely not. Anybody who has paid close attention to what happened in the oil commodities market last summer, basically admits that the spike in oil prices last year was due almost entirely to a couple of players in that market, Goldman and Morgan Stanley being the chief players among them. Last year, at the height of the oil commodities bubble, each barrel of oil was traded 27 times in the United States before it was consumed. So most of that rise in price last year was due entirely to a sort of an artificial rise in speculative demand for oil futures. In reality, supply was actually going up last year and demand was going down throughout this period, which means in real terms, oil prices should have been going down. The only reason they didn't go down is because banks like Goldman were encouraging people, particularly people who had lost money in the housing market, to suddenly start betting in the new craze, which was oil futures.
Right. So your article, The Great American Bubble Machine, I noticed this morning in the Financial Times, apparently the Obama administration is talking about regulating trading in oil to prevent oil bubbles. Is this a pushback against Goldman, and is Goldman powerful enough to stop it?
It is a pushback against Goldman in a couple of different ways. One of the things that Obama did when he came into office is that he nominated a guy named Gary Gensler to be head of the Commodity Futures Trading Commission, which regulates the commodities market. And Gary Gensler is actually a former Goldman Sachs banker who was an aide to Bob Rubin at the end of the Clinton years, and who was heavily involved in deregulating both this market and the derivatives market that involved credit default swaps and collateralized debt obligations. And what happened was that when Obama made this nomination, a couple of senators, in particular Bernie Sanders of Vermont, placed a hold on his nomination and demanded that in exchange for approving Gensler's nomination, that he enact a series of sweeping reforms to prevent what happened last summer on the oil market. So far, so good. He has agreed to do that, but the problem is there's a lot of opposition to these reforms actually going through. So we're going to have to see if that actually happens.
Amazing. Matt, can you stick around for a few minutes?
Sure.
Great. We've got a break here in just a couple of minutes, and then we can take it to the bottom of the hour. Matt Taibbi is with us. His article in Rolling Stone, The Great American Bubble Machine. I believe is it over at rollingstone.com now, Matt?
I think it should be, yeah. Part of it
Great.
Anyway.
Yeah, rollingstone.com. And we'll be back with Matt right after this break. This is just some amazing stuff.